Well, good afternoon and welcome to HYROX's weekly webinar where we are going to talk about what we see happening in the global economy and in financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. Inflationary expectations are rising, although to date most of the increases have been energy related. The odds are over 80% now that the Fed will raise interest rates by 1/4% next week. I'll talk about that a bit more. It is expected that earnings will grow at an approximate rate of 9.8% in 2017, but this has been lowered from 11.5% at the beginning of the year. However, we think valuations at 14-plus year highs are suggesting a little too much optimism in stock markets. The Organization of Economic Cooperation and Development, known as the OECD, today, while suggesting the possibility of a gradual improvement in global growth, highlighted that protectionism is the #1 risk facing the global economy. Well, one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds in the U.S. and in Canada. When we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Now, our style is to wait for opportunity and be tactical about how we take it. Now, if you had bought the global equity ETF a year ago using 100% cash, you would have experienced close to a 17.5% return over the course of the last year. But if you were bought in 2 years ago and held on, only a less than 5% total return. So you can see how a more tactical strategy can be a benefit. However, the longer you are invested, the smoother the growth curve, and is why we tend to focus on longer-term returns rather than shorter-term returns. And bond returns have certainly been a drag on total return over the last number of years. And here's the combined equity and bond benchmark returns. Now, I get questions from viewers who want to know why I show this same bunch of numbers each week. Well, if you're me, and I love the details and the statistics, this stuff tells a neat story. Look at the change in the 1-year balanced return over just 1 week. Really volatile. So you don't really want to look at the 1-year returns week to week because of the high potential for change. However, look at how smooth the longer-term returns are, and there is significantly less week-to-week change. That is the important story here. It is not about the quarter-to-quarter or even year-to-year changes that matter so much. It is the long-term growth that truly matters. And, of course, are we getting to your long-term goals? If we look at our HIROC client, the one-year performance is now pretty much in line with the benchmark, although it had been underperforming over the last couple of months, and the long-term performance is well ahead of the long-term benchmark. That is our success, which in turn is our client's success. Of course, historical returns are no guarantee of future returns, but at HIROC, as you all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy. And our forecasts for your net worth into the future are up to date and heading in the same direction as your goals. But we are watching the inflation story closely. After 4 years of commodity price deflation, prices started rising in early 2016, but have recently stalled out. They have been lower over the past few weeks. We are watching the central bank situation. Central banks have a mandate to maintain price stability. We are focusing on inflation as a key to determine if and when interest rate policy may change. Now, inflation data in most cases remain below target on a global scale, and although expectations continue to be for higher levels of inflation at the moment, we do not see any policy changes in any of the central banks other than the U.S. Federal Reserve, where they have a dual mandate to include efforts to promote full employment as well as price stability. The probability of a Fed rate increase by 1/4% is now 84% at the next meeting, which concludes with an announcement on March the 15th at 2 p.m. So we are expecting now that the Fed will raise interest rates by 1/4% next March 15th at 2 p.m. And this is despite weak forecasts for U.S. consumer spending and non-residential equipment spending that have pushed expectations of GDP growth to significantly lower levels for the first quarter of 2017. With only a few weeks left in the quarter, this hardly looks like a good environment for raising interest rates. So that will be something we're going to keep an eye on, of course. And on the week, the U.S. bond yield curve flattened, led by an increase in short-term rates as that March 15 rate increase becomes more built in to short-term bond and money market prices. In Canada, the Bank of Canada continues to keep monetary policy on hold as uncertainties over the U.S. trade policies remain a potentially significant economic problem. And so the Bank of Canada is now watching and waiting to see what outcomes come from the Trump administration. Well, on the debt watch, according to the OECD's report released this morning, significant global financial vulnerabilities stem from emerging market economies, although the sources of potential vulnerability differ across economies. The rapid growth of private sector credit and the relatively high level of indebtedness by historic norms is a key risk in some countries, notably China, fueled by favorable financial conditions amid low global interest rates. These high debt burdens, particularly of non-financial companies, leave economies more exposed to a rapid rise in interest rates or unfavorable demand developments. And the more significant financial vulnerabilities have risen from the over-reliance on monetary policy in recent years, which has led to an extended period of exceptionally low interest rates, rising debt levels in some countries, elevated asset prices, and a search for yield. In advanced economies, some countries have experienced rapid house price increases in recent years, including Australia, Canada, Sweden, and the United Kingdom. As past experience has shown, a rapid rise of house prices can be a precursor of an economic downturn. House price to rent ratios are at record highs in several countries and above long-term averages in many others. Although there has been a slower accumulation of household debt in recent years, mortgage debt to income ratios remain high in many countries. Well, as for value, expected earnings for 2017, as I mentioned before, have been reduced from 11.5% year-over-year growth at the outset of this year to currently a level of 9.8% growth. For the first quarter, early expectations of an 8% year-over-year increase have been lowered to 7.3%. But share prices continue to rise and outpace expected earnings. With lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.9 times, its highest level in more than 14 years. Now, while the 10-year average is at 14.4 times, this means that earnings will have to grow by about 20% more than currently expected to bring the ratio back to its 10-year average, or the S&P 500 will need to correct by 20%, or perhaps a combination of the two. At the moment, we don't want that kind of risk in our client portfolios. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. Well, on the geopolitical front this week, a new note from Goldman Sachs Group Inc. economists suggest investors are misinterpreting the political timeline and with it the market tea leaves. Led by Alec Phillips, the bank's senior U.S. political economist, the strategists predict that President Trump will be tied up with repealing the Affordable Care Act, known as Obamacare, this fiscal year, leaving little room for tax reform and infrastructure spending. Now, Goldman's timeline shows when the bank predicts these proposals will turn into some sort of policy action. The ACA will be a big focus until this summer, and tax reform could drag out into 2018. Infrastructure, meanwhile, doesn't even hit DC's radar until next year. So something to keep in mind. The House of Lords voted against a second Brexit referendum, but peers are likely to support an amendment forcing Theresa May to give Parliament a more meaningful vote on the UK's final deal at the end of 2 years of negotiations. Pollsters are predicting that Prime Minister Mark Rutte's People's Party for Freedom and Democracy will lose about 15 of its 40 seats in the 150-seat House of Representatives in the March 15 election in the Netherlands. Far-right anti-Islam lawmaker Geert Wilders' Party for Freedom, which currently has 12 lawmakers in the chamber, is on track to become one of the biggest, if not the biggest, parliamentary factions. However, Wilders' hardline anti-Islam, anti-immigration platform has driven away potential coalition partners among mainstream parties, meaning that it is unlikely to be able to form a government even if he wins the popular vote. And opinion polls currently suggest Marine Le Pen would be defeated in the second round, which would be held on May the 7th, by Emmanuel Macron. Without the backing of a traditional political party, the former economy minister who has never held an elected office is standing as a centrist candidate. So here at HIROC, with all of this and all of the other issues, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research as we continually do. And then keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. Bianca, did you just want to run over quickly? I know we did it last week, but maybe you just want to refresh everybody on what they're going to be receiving or what they may have received as far as tax situations are concerned. And if they don't, of course, please do not hesitate to get in touch with us.
Sure thing. So everyone should be starting to receive their T5008, that's their trading summary, as well as their T5s and their foreign asset verification report if they have U.S. holdings, non-registered U.S. holdings. Also a reminder that the T3 slips are not expected to be mailed out until the end of the month. So just to be aware of that.
And as far as their U.S. holdings, Bianca, is there a dollar amount that comes into play here?
Yes. So essentially, if a client has over 100,000 in U.S. holdings, non-registered holdings, then they'll have to file I can't exactly remember what the T form is, but if it's under, then they don't have to worry about that.
Okay. And if you do have any questions, please don't hesitate to get in touch with us, and we are more than happy to direct you as best we can. All right. Thank you, Bianca. And as always, we want to thank you for taking the time out of your busy schedule to tune in. If you have any questions, this is the time to come forward. All right. No questions this week, but if you do have questions, concerns, please definitely feel free to email them to us. We will certainly be back with our next update on Tuesday of next week. But until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a great rest of the week.